stocks which are lower. So not that much of a difference. And just 4 minutes into this market open. Sanjay Mookim is our market master. He's strategist and head of India Equity Research at JP Morgan, India. Sanjay, great to have you with us here. Thank you very much. How has, Sanjay, your view evolved on what we've seen over the last 2 weeks or so? A little less than 2 weeks. There has been a fair bit of turmoil, dislocation in markets because of troubles at a large business conglomerate. How are you viewing it, and what's the feedback from your global teams as well?
Well, good morning. Great to be on. Our view getting into the year, even in our year ahead notes, Nigel, was to suggest that India will probably need to go through another year of consolidation in 2023. Multiples for the index, multiples for a large set of stocks are still higher than average, still higher than where they were in December 2019. And as the growth momentum of the economy normalizes post the reopening bump that we've seen in 2022, you will need to start to consolidate into more average multiples. And this is not even rocket science, Nigel, because India outperformed EM last year handsomely by doing virtually nothing. The index delivered 4.8% returns in rupee terms and was negative in dollars. Yet we outperformed because North Asia was doing poorly. And we are reversing that trade now. As China reopens and places like Korea and Taiwan start to look better incrementally, then investor focus shifts to North Asia, and which becomes detrimental for India's relative performance. So 2 or 3 things. One, relatively, other people doing better. Absolute-wise, the Indian growth valuation cycle starting to normalize. We did argue that you will not see too many returns out of the index in India for 2023. And whatever's happened in the last few weeks kind of just supports that point of view, that there is additional volatility, there is additional beta in the market. And our recommendation to investors obviously has to be to move portfolios to large cap quality stocks in India and avoid the mid cap, slightly less illiquid names.
Okay, all right. So move portfolios to larger quality stocks. By the way, Sanjay, good morning. That was Prashant, and this is Sonia. So you're saying that you're a bit cautious on the market now, and it's better to perhaps stick with quality. But do you believe that the worst of the rate tightening cycle is now behind us, both globally and locally? And if that is the case, do you think that the market could be pricing that in and perhaps see an up move, even if India underperforms compared to its peers?
Good morning, Sonia. I think there are 2 sort of responses to that. The first is yes, that we do not really expect as a house any much more material rate increases, right? Maybe the Fed and maybe the RBI could potentially surprise you a little bit here and there, but we are at the peak of the tightening cycle. And this is, of course, contingent on the fact and the consensus view that inflation everywhere will continue to fall, as mathematics would suggest it will. The debate to have is whether you will actually see any rate cuts this year, whether it is at the Fed or at the RBI. And at least in the US, rate cuts seem to be priced into markets. So people are assuming that once the Fed gets to that 5.25 levels, it immediately starts cutting and ends the year somewhere in the mid 4%. And the debate there is, will that really happen? Will the Fed go to 5.25 and pause through the year, or will they immediately launch a cutting cycle? And that's where we are a little bit nervous, because we do not really see reasons for big rate cuts this year. Yes, the pause may happen, but the pivot is still debatable.
Okay.
Well, hi Sanjay. I recall, the last time when we chatted, you were talking about the China reopening theme. It has more legs. Some part of that has played out, right? Chinese markets are not as cheap now to the Indian market. So could we start finding favor at some point of time, given the recent underperformance of 3-4 months odd? Or do you think the outperformance prior to that was enough for us to consolidate for a longer duration?
Well, technically, look, we've just about given up our outperformance over the S&P 500 that we earned last year. And through the last 14-15 months, India is now on track with S&P in dollar terms. But we still retain significant outperformance over the EM index. So it is possible, just like I said, a very minor technical point, it is possible that India treads water for a little bit longer. The way I would think about it is that while the market in China may have gone up now, data in China will probably remain strong for the next few months. I mean, you will get, strong GDP prints, strong retail sales. All the reopening related positivity that we've seen in India through 21-22 will now possibly play out in China. So it might be very difficult, I think, for you to go out and say, hey, China's done into the strength of data that's still to come.
Okay, so what does this mean in terms of how to allocate your portfolio for the full year? If you think that India is going to perhaps underperform compared to peers like China, and then again, you know, there is this whole rural slowdown that's also taking place in the Indian markets. We are speaking to a lot of companies and it doesn't look like there's a massive recovery, at least on the consumption side. How do you structure your portfolio? What are the sectors that you keep? What are the sectors that you avoid?
Well, I'll make 2 or 3 comments there, Sonia. One, our filtering criteria and stock selection criteria is to look for earnings surprises. And that has worked well for quite a few years. We try and buy companies where we think earnings will beat estimates and sell companies where earnings will miss estimates. And starting this year, we are kind of struggling to find a broad basket of companies where we think earnings might exceed forecasts. Right? Because expectations have gone up a lot through last year because markets did well. Analyst forecasts are a bit too high to my mind. We are therefore this year filtering for stocks which will not miss estimates, where we don't see disappointments. And in that sort of a screening mechanism, banks still kind of rank very highly. Okay, we're seeing very strong on the ground momentum. Now you could argue that the upgrades for banks are also largely done because people have understood the phenomena of higher NIMs, lower credit costs, higher loan growth and so on. But at least we don't see risks that you will see significant earnings disappointments. And additionally, financials and banks remain the only sector in India which kind of makes sense on a DCF. So if you were to model the top 200, 300 stocks, it's largely the financials which make sense on a value screen as well. So both earnings and value point you in terms of financials still. The risk to banks, I think, this year would be macro. So should you start to see GDP growth disappoint, should you start to see some wage weakness or job losses, that could rub off negatively on banks in India. But for now, I think banks continue to make sense. And at least especially the large cap deposit funded banks are stuff that we favor. We don't like the high-end consumer space. The consumer discretionary, this is something I have been arguing for a few quarters now. It's playing out. Demand is coming out weaker than expected. Commentary is deteriorating for companies where multiples remain very high. So our big long short is to save long financials and short the consumer discretionary. As defensives, we still have staples. We like real estate. We upgraded insurance before the budget. Now we'll have to see how that plays out.
No, even on banks, and you're exactly right, what matters, of course, is earnings, the degree of earnings surprises or disappointments. Even in banks, not seeing too many upgrades. I mean, except SBI, which has seen some 3-4% upgrade since over the last month or so, not very much by way of upgrades. IT is one area where, your analysts had a very strong view. How has that view evolved now, and where are stocks after the recovery they've seen?
Well, the trouble with IT is twofold, right? I see the argument from a lot of clients who want to rotate into a sector that has underperformed last year and which are perceived as great corporate governance, good cash flow generating businesses. The trouble is that we're still staring into a down cycle. And, as the US economy slows, as developed country economies slow, the top line outcomes for many of these IT companies are likely to deteriorate. And this is, I think, very well modeled, very well appreciated by analysts and investors. The debate is around the margin outlook for next year because most estimates imply an expansion of margins in FY24. And our nervousness is around the fact of negative operating leverage. When your top line is slowing, will companies really be able to deliver on the expected margin expansion through next year? And if they don't, then you will see earnings misses, earnings downgrades, and so on. And lastly, some of the large cap IT names are still trading above average and still trading above December 19 multiples. So you don't really have comfort entirely on valuations, not on the EPS as well. But I see a lot of people trying to diversify portfolios because they've owned banks for a long time. And IT makes a natural candidate for a lot of my investors.
All right, we will let you go on that note. Thanks a lot for stopping by and speaking to us. There are lots of stocks to discuss.